But first, you need to know the rules and benefits before you open an HSA in 2023. So here are some quick facts about the HSA that you need to know. An HSA is for people who are enrolled in a high deductible health plan, also known as the HDHP. Don't confuse HSA with FSA because they're entirely different from one another. The money you put in the FSA has the rule to use it or lose it every year. But the money you put in the HSA can be carried over year after year. You can make pre-tax contributions to the HSA, grow your investments tax-free, and withdraw your HSA tax and penalty-free for medical expenses. Not to mention that you can reimburse yourself whenever you want, no matter when you made the medical expenses. And since I have to keep at least $2,000 in cash inside the HSA, because of the rules with my HSA broker with Optum Bank, I consider $2,000 as a part of my emergency fund in case I have a major medical emergency that requires a high deductible or some type of premium. And I'm going to use HSA as a part of my travel fund. Yes, you heard that correctly. When I retire early, I'm going to use it as a travel or entertainment fund because I'm going to have all the medical receipts saved from 2022 until the day I retire. So if I spend $3,000 a year in medical expenses in 2022, I can use the receipts I saved for $3,000 and reimburse myself in 2031, 2032, or whenever I want. It's like going on a work trip and getting reimbursed by your employer for all the per diem, but you get to choose to be reimbursed whenever you want. And if you're leaving your employer anytime soon, you can actually use the HSA to help pay for the COBRA premiums to continue your medical coverage. And if you're already 65 years old, you can use HSA to pay for Medicare Part B, Part D, and Medicare Advantage premiums. And also, just because you change your health insurance plan, it doesn't mean that you need to close your HSA. If you change your health insurance plan from an HDHP to a non-HDHP, you can still keep your HSA open, but you just won't be able to contribute to it. And lastly, there are some special rules when it comes to having FSA and HSA at the same time. And I'm going to go over it later on in the live stream. And let me show you this. This is IRS publication 502. If you look at this, it tells you what qualifies as a medical expense. And I know this is from 2022 because they don't have the 2023 version yet. And if you go to page 3, under the family plan, the qualified medical expenses will cover your spouse and children, but you just need to make sure that they're on your health insurance plan as well. And page 4 tells you what person in your family is a qualifying relative. And starting on page 5, you can find qualified, here we go, qualified medical expenses in alphabetical order. It also includes your dental and vision expenses like contact lenses and dental treatment. So I encourage you to join my private Facebook group or become a member of my channel because I have a public live stream and private group session every other Wednesday to talk about all kinds of financial independence investment and early retirement strategies. You can visit firesidechat.com/pricing or firesidechat.com/coaching to schedule your financial coaching session. And I want you to keep in mind that California and New Jersey have different tax rules when it comes to HSA contributions, which I mentioned earlier in the live stream. And if you're watching this on replay, just watch the previous clip and you'll see how California and New Jersey still tax your HSA contributions. And if you're looking to see if you're qualified to open an HSA, you need to look at your current health insurance plan, and it should tell you if you're in a high deductible health plan or HDHP. It might not tell you on the surface, but let me just give you the breakdown here. So a high deductible health plan has certain requirements for deductibles and out-of-pocket expenses. For the year 2023, the minimum deductible for the individual plan is $1,500, and the minimum deductible for the family plan is $3,000. And the maximum out-of-pocket cost for the individual plan is $7,500, and the maximum out-of-pocket cost for the family plan is $15,000. And keep in mind that the out-of-pocket maximum includes co-payments, deductibles, and co-insurance amounts, but they do not include the premiums. And these amounts do increase every year based on inflation. And the HSA will come along with your HDHP. If you don't have an HSA now, then you're probably not enrolled in an HDHP. The other possibility is that you have an HDHP, you got an HSA debit card, and you just completely forgot about it. Trust me, healthy people actually forget to do their annual checkups and end up forgetting about the HSA. Um, and speaking of the HSA, the maximum contribution limit for the individual plan is $3,850, and the family plan is $7,750. There's also a catch-up contribution for the people over the age of 55 to contribute an extra $1,000 each year. The $1,000 catch-up contribution hasn't changed in a while, but the contribution limits do change based on the annual inflation rate. We saw a big jump in the HSA contribution limits in 2023 because of the high inflation we saw in 2022. And I want to show you this. And if you truly want to dollar cost average by deducting your paycheck, this is what I do with my HSA contributions. Before the year began, I knew that 2023 had 26 pay periods because I get paid biweekly. But you have to know how much your employer is going to contribute to your HSA. And in my case, my employer contributes a very generous amount of $1,500 every calendar year. Put employer, okay? So I need to subtract $1,500 from the maximum contribution limit of $7,750 minus $1,500. Because the employer contributions are included in the maximum HSA contribution. So that leaves me $6,250, okay? So, to simply put, I just divided $6,250 divided by 26, and that's gonna give me $240.38. And that's gonna be my contribution amount every 2 weeks directly from my paycheck to my HSA, including my employer contributions. And if you get paid twice a month, then just divide your personal contributions minus the employer contributions by 24. So basically the formula goes just like this. It's your maximum, your personal contribution, okay, minus employer, and then divided by the amount, your total pay periods in 2023. So if you get 26 paychecks in 2023, then that's how many times you divide it by, or you can divide it by 24. It's just depends on how frequently you get paid. Easy peasy, right? But when can you not contribute to your HSA? One, if you or your spouse are enrolled in TRICARE, Medicare, or Medicaid. Two, if you receive VA medical benefits for any non-service connected disabilities in the past 90 days, you're not going to be eligible for the HSA. Three, if you're claimed as a dependent on another person's tax return. Four, if you have a healthcare FSA or healthcare HRA, which stands for flexible spending account and health reimbursement arrangement, respectively, then you're not eligible to contribute to your HSA. The only exception is if you have the limited purpose or limited healthcare FSA, then you can contribute to both of them at the same time, which I'll cover in the next segment of this live stream. So be sure to subscribe if you haven't done that already. And five, you do not need to be employed to contribute to your HSA. This is different from the Roth IRA. You don't need to have an earned income to contribute to your HSA, but you will need to be enrolled in a high deductible health plan or HDHP to open an HSA. You just need to make sure that you get the health insurance that clearly says that the plan is HSA eligible. And six, this is a little bit complicated, so bear with me here. If you're married and you and your spouse both work for separate employers, let's say you have an HDHP with an HSA, but your spouse has a non-HDHP insurance plan, then the spouse with an HDHP is the only one who's eligible to contribute to an HSA. You would need to get an individual plan for the HSA with a maximum contribution of $3,850. The same rule applies if one of you has TRICARE or retire with Medicare. If you're not sure which plan you're on, make sure to contact your company HR or talk to your local CPA before you file your tax return in 2024 so you don't get penalized by the IRS. So if you're a self-employed individual like me, you can find your own HDHP and establish an HSA. Just make sure to read the IRS publication about the eligibility requirements. And you need to be very careful with the HSA contribution because if you over contribute to your HSA, you're going to end up paying a 6% penalty on the excess contribution. And keep in mind that it's your personal contribution and not the interest and earnings that you make inside your HSA. You also need to make sure that your spouse isn't enrolled in the non-HDHP insurance plan, or you could end up over contributing to your HSA and you could end up with more IRS penalties. But don't be discouraged if you can't open or contribute to your HSA right now because your employer doesn't offer an HDHP. You can ask your employer to maybe consider giving you the option to have an HDHP insurance plan. It's up to your employer though. But it's not always beneficial to have the HDHP if you have an ongoing medical condition that requires you to pay thousands of dollars in copayment, or you just don't have enough cash to not use your HSA. If you're a healthy individual who doesn't need to spend a lot of money on medical or dental expenses every year, then I would treat HSA like a separate investment or retirement account so you can retire early with it.